Here's something you may not know about your home's equity. 5 ways to tap into your home equity to enhance your financial well-being and seize opportunities. We're going to talk about that here for a little bit today and explain what those 5 opportunities would be. Here's something else you may not know. My helper fell asleep on me today. So I'm double dutying it, and my partner here fell asleep. But anyway, before we get started, I wanted to share a testimonial with you. This come in from Bob and Mindy. This can be found on our wyomingforsale.net website. You made buying a home so easy for my wife and I. We were grateful for how much patience you used in sharing all of our used in answering all of our questions and taking us to look at so many houses. You never pushed us into looking at something we were not interested in. We strongly recommend you to anyone looking to buy a new home. Thanks for sharing that, Bob and Mindy. And you're right, the basis of our business is not to be pushy salesmen, and we are always patient. You know, everybody's circumstances are different, so thanks for pointing that out. And we don't care how many doors we got to get in to find you the right property. It could be 3, it could be 30. We've always said that. We hold true to that. So thanks for recognizing that and pointing it out in your feedback. So anyway, back to the topic at hand today. 5 ways to tap into your home's equity and chase after some financial endeavors you wish to pursue or to take care of in some cases. Your home is not only a place to live, but it's a valuable asset that can serve as a financial resource that when you need it the most. One of the most significant advantages is the opportunity to build equity over time, which can be accessed then in various ways to fund life's important milestones or unexpected expenses, right? This could include a home improvement project, a vehicle purchase, paying medical bills, buying a business, debt consolidation, covering educational expenses for either yourself or your children or anyone else for that matter. Or it can just simply ensure take a vacation. See that happening a lot. Or to simply ensure financial flexibility for the future. So let's go over with the 5 of these options, and I'll try to explain them to you a little bit and see what you like the best. First, home equity loans. This is a fixed amount loan using the equity in your home as collateral. You receive a lump sum from the mortgage lender and you pay it back in regular intervals over time. This comes with a fixed interest rate and a fixed amount of months or years to repay that, right? So here's an example. Your home or property might be worth $500,000 and you owe $100,000 on your primary mortgage. The mortgage lender will tell you we'll lend up to 80% of your equity position on the home, meaning you can have an accumulative debt of $400,000. $400,000 minus the initial $100,000 that you owe will net you a $300,000 lump sum that you'll receive upon signing your paperwork and closing on your second loan. Pretty easy peasy. You know it's all fixed. It's just like your primary mortgage. You get a fixed interest rate, fixed APR, and you know the terms of that. You know that there's nothing variable, and you know the end date unless you're paying extra payments, and that end date kind of gets that'll get moved forward, right? So that's option number 1. Option number 2, home equity line of credit. So similar to the home equity loan, but this is just a line of credit. Think of this like a credit card. You're going to be your own Discover card or your own Visa or your own MasterCard, right? So in the mortgage world, for short, it's called HELOC. It's called a HELOC loan. And HELOC loans provide a revolving line of credit using the home's equity as collateral. Okay, you as a homeowner can borrow as much or as little as you need at any given point in time. So you literally get a credit card, you can go swipe it, make some purchases, go buy your vehicle, pay off some other debts, do whatever you got to do. And now it'll come with a cap, just like the home equity loan. There's always going to be the cap, right? But you can pay it down, and then if you need to borrow against it again, you just swipe the card or write the check, and you go at it again. Now the fun part is, just like your credit card, this is where it's different from a home equity loan. If you have a zero balance on your home equity line of credit, you're not going to be charged any interest for that month. But if you have a balance on your home equity line of credit, then the interest rate that you've agreed to pay the mortgage lender or the bank is going to be assessed for that month. And of course, it being a revolving line of credit, your daily loan amount, right, your daily credit goes up or it can go down within the month, so it's always calculated on the day. So keep that in mind, and it's a super effective tool if you know how to use it right. A lot of businesses can operate on a function similar to this, and kind of avoid that. The key component here is, instead of using like a credit card from Visa or MasterCard or whomever, American Express, where you're paying 16 to 28 or 32%, you might get a home equity line of credit for 8 or 10%. So significantly less on the interest rate department versus a credit card, but this functions like a credit card. So it comes with a lot of wins here. I know a lot of folks that utilize this option and get along pretty good. Third option, cash out refinance. So similar to the home equity loan, to where there's, you're going to get a lump sum payment or lump sum of money at closing from your mortgage lender. But instead of two loans, like on option number one, this option on the cash out refinance is going to pay off your primary loan first, and then the difference between the equity position and what they paid off on your original loan is going to be the lump sum of money they give you at closing. So back to our example of your property's worth $500,000 and you owe $100,000. In the cash out refinance situation, they again will loan you up to, probably about 20 or 80% of the home's value, and then they're going to pay off your first loan at $100,000, right? And then that leaves you the $300,000 difference again, but there's only going to be one loan left with new terms. You get the new interest rate, and it's amortized out for X amount of years that you and your mortgage lender decide. Maybe you do a cash out refinance that's in a 30-year loan. So your primary loan that you may have had it for 10 years. You paid it off with the cash out refinance, and you just extended the length of your loan, right, with this new loan or the cash out refinance option. But I've seen it where your payments go down. You pull out a lump sum of money, and sometimes the interest rates are below what you originally got your first mortgage for, and your payments can be less. Like, don't always assume it's going to go up. Sometimes your monthly obligation to making payments against your home could go down, or it could go up, but maybe it's worth, if you're doing debt consolidation or wanting to take that family vacation or whatever, maybe it's worth it's worth that your monthly payment goes up to $100 a month, and you can afford that easily, versus again trying to max out your credit cards. Like, that's always dangerous waters in itself. This is less dangerous. Okay, Option number 4, the reverse mortgage. This is available to uh, folks that are typically 62 years of age or older, and it allows them to convert their home's equity into reverse payments. Okay, so instead of them paying the mortgage company a monthly payment to pay down the mortgage company actually pays the homeowner a stipend every month based on, what the goal setting was, what the home's worth was, and life expectancy, right? Be very, very careful here. You could outlive the expectancy of this loan. For example, you may think when you take out this reverse mortgage, you're only going to live another 10 years. And so you structure this whole thing to where the bank pays you monthly payments for the next 10 years. 120 payments, next 10 years, you're getting $500 a month, whatever the amount of money is. And you're just convinced you're not going to live past that 10 years. But then you do. If you can't buy out your mortgage or start paying it back down, and start making payments back to the mortgage company, they will foreclose on you. I've seen it done. I've been brought in on conversations, and the last one that happened was I met with an elderly lady that outlived the life of her loan, the reverse mortgage. She asked me to sell the property to pay back the loan, and she was upside down. The mortgage company had overvalued the property based on condition, location, and age, and several other factors. They had overvalued the property. There was no way, no chance I was going to sell it for what they was owed against the property and get her moved out. Now, unfortunately, the move out was coming down the pipeline for her. The bank foreclosed on the property, and she was moving anyway, right? Like if I sold it or if they foreclosed, she was moving anyway. Miscalculated the life expectancy of the loan. She outlived it and got in some real trouble. And so anyway, I offer that experience with you because of all these options, that is the most dangerous. Okay, in my opinion. Keep that in mind. That's my opinion. That's the most dangerous. Option number 5, the sell-buy strategy. It's an option. Instead of keeping your current home, you could sell it and then buy a lesser expensive home and then use the profit or the equity difference for the purposes outlined for why you're wanting to cash out. This is a little bit more of a drastic approach because it involves moving and timing and entering the market and all the market activities, showing the property, but it's an option, and a good lot of we see people doing it, especially if your bigger property is free and clear and you want to pull out maybe 100 grand and you don't want a loan, you don't want to pay the bank, sometimes easier just to sell and buy a smaller property and just move on. So that's definitely an option to keep in mind as well. Each of these, as I've explained, each of these options has its own advantages and disadvantages. So you should carefully sit down and evaluate each one of these with your financial advisor and your mortgage lender. If there's a buy-sell option in the works or in the conversation, I'm your realtor, right? Like that's where I get brought into these conversations. So I'm sharing this with you as an educational piece. You can kind of chew on it a little bit. Sometimes back with life's unexpected events, you don't always have the time you need to make a better decision. There's good decisions and then there's better decisions. Sometimes you don't have the chance to kind of chew on those and marinate on them when they happen. So by offering this to you, hopefully it kind of just plants the seed a little bit and gets your thought processes working, and maybe it'll help you out if need to in the future. Uh, and again, as a homeowner, you can leverage your home's value to enhance your financial well-being and seize some opportunities if they come your way. Uh, so anyway, give us a shout when you're ready to buy or sell real estate. Thanks for being a subscriber, and we'll talk to you later. Bye.